Hello students, welcome to EPG Pathshala. I am Dr. Ashish Sahajpal, Assistant Professor from University Business School, Punjab University Regional Centre, Ludhiana, Punjab. Today we are going to discuss about a module, Strategic Choice, under paper Strategic Management. After completing this module, we will be able to understand the processes, the tools, and techniques used for strategic choice, the importance of subjective factors in strategic choice. Strategic choice is looked upon as a key aspect of strategic management process. The process of strategic choice is essentially a decision-making process that has a lasting impact onto the organization's performance. The decision-making involves relating intent to the vision, mission of the organization, generating alternatives, choosing one or more alternatives that helps the firm to achieve its objects, and finally, implementing the chosen strategy. Thus, for the purpose of selecting or rejecting alternatives, the managers have to ascertain a set of criteria. These criteria are termed as selection factors and can be broadly classified into two groups, the objective and subjective factors. The objective factors are basically data-driven and are based on analytical techniques, whereas the subjective factors are based on one's experience and personal judgment. Process of strategic choice. The process of strategic choice comprises of the following four steps. First, relating intent to the vision and mission. Second, generating alternatives. Third, assessing the options. Fourth, selecting one option that fits with the intent. A foremost step in the process of strategic choice is to define the intent and relate it to the vision, mission, and goals of the organization. Unless this intent is clear, it would be difficult to generate alternatives and further assess them so as to facilitate a strategic choice. Figure 1 illustrates that the strategy chosen must help fulfill a strategic intent from a set of generated strategic options, of which some are subsequently valid by assessment. For example, Tata Global Beverages states its vision as to be the most admired natural beverage company in the world by making a big and lasting difference in tea, coffee, and water. While the purpose is stated as we will focus on creating magical beverage moments for the consumers and an eternity of sustainable goodness of our communities. From the above stated vision statement, it is clear that the company's business focus area is in natural beverages, that is tea, coffee, and water, whereas it ignored the other feasible alternatives in natural beverages segments like juices, nectar, etc. Further, having a closed look onto the intent, the key is to build company as an admired global company in natural beverages, for which it has chosen the strategy that focuses on building unique competitiveness, differentiated offerings, appealing brands, and significant scale in the three natural beverage categories of tea, coffee, and water. Tata Global Beverages has grown through innovation, strategic alliances, and acquisitions, and organic growth. Over 60% of the company's consolidated revenue originates from the market outside India, and more than 90% of the turnover is from branded products. Okay, students, now we'll focus on the approaches to strategic choice. It is well acknowledged that strategic decision making is a complex activity, whereas no single factor is adequate for making a strategic choice. The various approaches used to generate the strategic alternative range from some of the most simplest techniques that are based on intuition, are judgmental and descriptive in nature, to highly sophisticated analytical models such as Product Lifecycle, Boston Consulting Group, Matrix, GE 9-cell model. These models provide generic guidelines for specific business situations. With the help of these approaches, a blueprint is drafted that helps to describe the strategies and the conditions under which they could be made to operate. Boston Consulting Group Matrix. The BCG matrix is a corporate portfolio analysis technique that helps the strategist to take decision with regard to the individual product and business units in a firm's portfolio. The basic purpose of adopting this particular approach is to channelize the resources at the corporate level to all the businesses, that is SBUs, and products that hold greater potential under the corporate umbrella, so as to enable the company to identify the suitable strategies needed to maintain the firm's strong position in the industry or to regain the one lost. BCG developed a four-quadrant matrix based on the empirical research. The matrix analyzes the different products and businesses in its portfolio based on the two parameters, that is, relative market share and industry growth rate. The relative market share refers to the ratio of the firm sales to that of the sales of industry's largest competitor or the market leader, whereas the industry growth rate is the rate of growth in sales in percentage for a particular industry. The pictorial depiction of BCG matrix. The four quadrants of the matrix are termed as star, question marks, cash cow, and dogs by Boston Consulting Group and are as follows. Stars, the quadrant labeled as star, represents the products or businesses that have high market share and holds high industry growth rate. These are the businesses that may or may not be self-sufficient in cash flow. They possibly require cash in excess of what they generate for meeting the capital expenditure so as to maintain their market position and for securing high returns in the future. Since the stars are the businesses that are growing fast in the market and have already attained a large market share, therefore, they happen to provide the corporation with the best profits and growth opportunities. Henceforth, the profits generated may be utilized for its own future business expansion. Cash cows. It is interesting to note that in due course, the stars may become cash cows, which are classified as low growth with high market share businesses. The cash cows are the businesses that generate high levels of cash flows but needs very little fund for capital expenditures because industries in which they operate have lost its attractiveness. The strategic features of cash flow is that the high cash returns generated may be used to pay dividend, debts, or to finance the stars. The best suited strategy that these businesses may adopt is stability or a phased retrenchment strategy. Question marks. Also termed as problem child, question marks are the businesses in high growth market but with a poor market share. As the label of quadrant suggests that the future of this business is in dilemma, so a decision needs to be taken whether to invest in these businesses with a hope that they will gain its market share in near future, or to allow them to die a slow death as they have already been squeezed out by the rivals. Therefore, no single set of strategy could be recommended for the businesses falling under the question mark category. Question marks holds the opportunity of becoming the stars if enough investment is made into them or may become dogs if ignored or neglected. Dogs. Dogs are categorized as the businesses with a low market share in a slow growth industry. These businesses may have been cash cows at some time but have now fallen on hard times. They neither generate or require any funds and are cash strapped that fails to provide any return on investment. The businesses or products categorized as dogs should be allowed to die or be killed. Therefore, retrenchment is the recommended strategy for such businesses. The summary of BCG metrics and its strategy implication are illustrated as below. Stars. They have relatively high market share, high industry growth rate, and the strategy recommended is expansion. For the cash cows, the relative market share is high, industry growth rate is low, and the strategy recommended is stability or phased retrenchment. For products categorized as question marks, they have low relative market share and high industry growth rate. The strategy recommended are invest or retrench. Dogs are those products which have low relative market share and low industry growth, wherein the strategy recommended is retrenchment. The major advantage of BCG model is that it showcases a pictorial representation of the portfolio of businesses products of a company, which make it easier to classify the businesses products and the strategic alternatives to be implemented. The critics consider the BCG model to be a fundamental approach that lacks the practical applicability. It is, however, difficult to measure the respective relative market share of different businesses in a given portfolio and, above all, to identify the market leaders. Keeping these limitations in view, many other techniques of portfolio analysis has been proposed that are discussed in the following subsection. GE 9-cell metrics. The General Electric Company, in assistance with the consulting firm of McKinsey & Company, developed a 9-cell corporate portfolio analysis grid in an attempt to overcome some of the limitations of the BCG metrics. GE metrics is henceforth a more advanced technique than the BCG metrics, in a sense that each dimensions of GE 9-cell metrics is a composite measure of several component factors, whereas BCG metrics consider evaluating its two dimension based on single factor only. The two dimensions of GE metrics are industry attractiveness and business strength, which are determined by various other factors. However, BCG metrics uses the market growth rate as a proxy for industry attractiveness and relative market share as a proxy for business strength. The ongoing slide demonstrates a GE 9-cell metrics. The vertical axis of the metric represents the industry attractiveness, while the horizontal represents the business strength. Exhibit 2 demonstrates a GE 9-cell matrix. The vertical axis of the matrix represents the industry attractiveness, while the horizontal represents the business strength. The industry attractiveness is determined by the component factors such as market size, market growth rate, industry profitability, demand, variability, competitive intensity, macroeconomic factors, that is pastel, political, economic, social, technological, and legal factors. While business strength is again a composite measure of several factors that includes relative market share, growth in market share, product quality, pricing, brand equity, distribution channel access, capacity utilization. The procedure for calculating the composite value for industry attractiveness and business strength respectively involves assessing each of the component factor a weight depending on its perceived importance and multiplying it with the estimated value using a 1 to 10 rating scale. It is important to note that the weightage assigned to each factors and the ranking given by the analyst are based on detailed research. The respective dimensions of GE metrics are calculated as below. Industry attractiveness slash business strength equal to the factor value into the factor weight 1 and subsequently the nth factor. The businesses in firm's portfolio under consideration are plotted onto the metrics based on the composite values calculated for industry attractiveness and business strength respectively. The businesses or products are represented by circles. The sizes of the circles represents the sizes of relevant market, while the market share is represented by using circle as a pie chart. The position of the business in the metric suggests an appropriate strategy for the business. However, it is to be noted that there are strategy variation within the respective zones or groups. The 9-cell matrix is grouped into 3 zones of 3 cells each that are denoted by green, red, and yellow colors, for which the matrix is also known as traffic light signal model. For example, within the red zone, the firm would be quick to divest its weak SBUs operating in an unattractive market, whereas it might undergo a phased harvest of business of an average strength in the same industry. The 3 different zones are explained as below. The diagonal cells, that is yellow, from low left to the upper right represents the businesses units that are mediocre in overall attractiveness. Such SBUs may require selective investment, that is, resource allocation recommendation of these businesses may be of hold type strategy, that is, wait and watch, which is aimed at stability and consolidation. The third cell, that is the red vertical lines below the diagonal cell, represents the SBUs that are low in overall attractiveness. The appropriate strategy for these businesses would be retrenchment or harvesting. However, the 3 cells, that is the green horizontal lines above the diagonal lines, represents the businesses having strong competitive position in a highly attractive industry. These businesses require resources for further development and to ensure that at least their market share grows along with the growth in a given industry. Product life cycle. Product life cycle is yet another technique for making a strategic choice. It helps to map the stages in a product's sale history and assist in understanding that how the strategy under the pursuance would be helpful to position the business units. The Exhibit 3 demonstrate a classical PLC pattern. The 2 axes of PLC graphs are sales/profits, that is the x-axis, and time, that is y-axis, where the profitability and the sale of a product can be expected to change over a period of time. PLC therefore is an attempt to identify the distinct stages in the life cycle of a product and to suggest the appropriate strategy. The 4 phases of product life cycle are discussed in detail as follows. Introduction phase. The first phase of the life cycle, that is identified with slow acceptance of the product by the consumer, inconsistent production cost, and hurdle in the initial setup of the operation. This stage is generally categorized by low sale, low or no profits. Growth phase. At this stage, the product is being able to overcome the initial hurdles and becomes equally accepted by the consumer, henceforth giving sharp rise to the demand of the product in the market. The revenues tend to grow because the firm starts to enjoy larger economies of scale that helps to achieve low unit cost of production and enhanced profit margin. The prospective firms try to enter the industry because of high growth
attained by the industry and ultimately leading to increased rivalry amongst the firm in the industry. Therefore, product differentiation and cost leadership approaches become more important for competing and retaining the market share.
The maturity phase. In this stage, the growth rate slows down and stabilizes. This is a fairly longer phase in the life cycle of a product. The product becomes mature and has a defined demand in the marketplace, though has the capacity to generate a constant or slightly declining profits. Therefore, the focus is to prolong the duration of this phase by way of product modifications or improvement so as to remain competitive in the industry. The next phase, that is the declining phase. This is a logical phase and is inevitable. The old product gives way to new ones. However, the path of decline may differ for different products. Some products may have an abrupt ending, while other may have a fairly long one or in a phased manner. This shrinkage could be due to markets becoming saturated, technological interventions making the product obsolete, or change in consumer preferences, etc. In this way, a strategic choice may be made based on the life cycle concept. The next, we'll be talking about the subjective factors in strategic choice. The strategic decision making is a complex activity, whereas no one factor is sufficient for exercising a strategic choice. Strategy formulation is looked upon as an art as it is a science. The strategist would be capable to sense the future opportunities and respond quickly to build a strong position from a business. It becomes imperative for one to understand the strategic choice is not merely an analytical process, but take into account the subjective factors too. It would be wrong to assume that subjective factors are irrational and non-analytical. Rather, they engulfs many of the issues that cannot be dealt with the help of analytical models. The subjective factors are basically intuitive and descriptive in nature. Some of the important subjective aspects of strategic choice are culture, politics, managerial biasness, and leadership style.
For example, on shifting of Tata Motors' nano plant from Singhur, West Bengal to Sanand, Gujarat, Mr. Ratan Tata was asked that how he would be like to remember. He said, "I would like to be remembered as someone who had never hurt others and done work to the best interest of business." 6 years hence, Mr. Tata termed shifting of nano plant from West Bengal as a prudent move, though to the group it gave a high negative cost. Shifting of Tata Motors' fully built passenger car plant from Singhur to Sanand, approximately a distance of 2,000 kilometers, was perhaps an unprecedented operation of such a scale that might have ever happened anywhere in the world. Over 3,340 trucks were used to transport the plant from Bengal to Gujarat in 7 months. This decision to shift the plant was announced in a wake of political unrest and farmers' agitation led by Mamata Banerjee, leader opposition party in West Bengal, against the acquisition of farmland by the state government to have Tata build its factory. It was the group chairman's Shri Ratan Tata firm commitment to deliver the nation a small car at $2,500 that led to the strategic decision of shifting Nano's plant from Singhur to Sanand.
Dear friends, now we'll summarize the module. The strategic choice process is a highly complex activity that requires a structured strategic thinking mechanism. One may note that no single technique or tool is adequate to make the strategic choice decision. The process of strategic choice is divided into 4 steps, that is, relating intent to the vision and mission. Second, generating alternatives. Third, assessing the options. And fourth, selecting one option that fits with the intent. Further, the selection factors for making the strategic choice can be broadly classified into 2 groups, that is, the objective and subjective factors. The objective factors are basically data driven and are based on analytical techniques, whereas the subjective factors are based on one's experience and personal judgment. The highly sophisticated analytical techniques includes models such as product life cycle, the Boston Consulting Group, Matrix, the GE 9-cell model, whereas some of the important subjective aspects of strategic choice are culture, politics, managerial biasness, and leadership style. Thank you.